When a stock makes a higher high and higher low at the weekly level, but closes below where it opened, you're not looking at a bullish structure. You're looking at rejection disguised as continuation. NVIDIA delivered exactly this contradiction through week 6. Monday morning spiked to $193.66, making a new weekly swing high and exceeding week 5's peak by over $3. The setup looked perfect for bulls extending January's recovery. By Friday's close at $182.81, NVIDIA sat $1.45 below Monday's open, positioned in the lower third of the week's range, having just collapsed to $181.59 mere hours before the closing bell. This is the pattern professional equity traders recognize instantly, while retail participants miss completely. The weekly candle technically shows higher high bias, $193.66, exceeds week 5's $190.30. The weekly candle technically shows higher low bias, $181.59, holds above week 5's $171.03. Structure says bullish continuation, but the close at $182.81, sitting just $1.22 above the weekly low and $10.85 below the weekly high, tells a completely different story about who actually won the week's battle between bulls and bears. Here's what makes week 6 critical in NVIDIA's larger narrative. October 2025 peaked at $212.19 before November collapsed to $177. December and January attempted recovery, getting back to $191.13 by late January. Week 5 tested whether that recovery would hold, plunging to $171.03 before bouncing. Week 6 opened attempting to confirm the recovery was real. Monday's spike to $193.66 suggested yes. Tuesday through Thursday's struggle to hold above $186 to $190 suggested uncertainty. Friday's collapse to $181.59 and close at $182.81 suggested the recovery is fragile, participants are unconvinced, and the weekly higher high, higher low structure maintains bullish labeling without delivering bullish conviction. The semiconductor giant that rallied from $49 in early 2023 to $212 in October 2025, a 430% gain in under 3 years driven by AI revolution demand, now trades at $182.81, struggling to reclaim and hold $190. Week 6's contradiction between technical structure and actual price behavior reveals a market at an inflection point where the label says one thing, but the internals scream another. This week either represents healthy consolidation within continued uptrend requiring more time to build energy, or it's the warning that October's $212 peak was the top and everything since has been distributed under the guise of recovery attempts. This institutional-grade price action analysis is presented by Price Action Traders Stocks. This analysis covers week 6, spanning February 9, 2026 through February 13, 2026. The content provided is for educational purposes only and does not constitute financial advice. Trading in stocks involves substantial risk of loss and is not suitable for all investors. If you find this useful, subscribe for daily breakdowns. We also run separate dedicated channels for crypto, forex, futures, and metals, each publishing daily. Links below. Quick question. Did Monday's spike to $193.66 make you chase the breakout thinking recovery was confirmed? Or did the failure to hold above $190 through the week keep you cautious? Drop whether you bought Monday's strength, sold into it, or stayed flat, recognizing the whipsaw developing. Let's establish where NVIDIA sits within its price structure by examining the last 6 months of monthly action, the recent 6 weeks of weekly movement, and how week 6's daily candles created both a weekly swing high and weekly swing low while closing in the lower third of the range despite technically bullish structure. Starting with the monthly time frame working backward from February, August 2025 opened at $174.09 and closed at $174.18, showing higher high bias. The monthly range of $15.68 from the high at $184.48 down to the low at $168.80 ran against a 3-month average true range of $24. The 50% midpoint sits at $176.64, and the close at $174.18 came $2.46 below the midpoint, positioning August in the lower half of its range despite the higher high label, showing weakness within the advance. September delivered outside month bias, opening at $170 and closing at $186.58. The monthly high of $187.35 and the low of $164.07 created a $23.28 range running against a 3-month average true range of $24. The 50% midpoint sits at $175.71, and the close at $186.58 came $10.87 above the midpoint, well into the upper third. September's strong close, $10 above midpoint after August's weak close below midpoint, showed momentum building. October maintained higher high bias, opening at $185.24 and rallying to close at $202.49. The monthly high reached $212.19, marking the peak of the entire structure and NVIDIA's highest level since the explosive AI-driven rally. The low at $177.76 created a $35.43 range running against a 3-month average true range of $26. The 50% midpoint sits at $190.44.5, and the close at $102.49 came $8.01.5 above the midpoint. October made new all-time highs at $212.19, closed strongly above its midpoint, confirming the rally accelerating. November shifted dramatically with lower low bias, opening at $208.08 and collapsing to $177. The monthly high of $211.34 and the low of $169.55 created a $41.79 range running against a 3-month average true range of $34. The 50% midpoint sits at $190.44.5, and the close at $177 came $13.44 below the midpoint. November opened near October's highs, briefly tested above them to $211.34, then collapsed to close well below the midpoint, showing reversal from the peak. December showed inside month bias, opening at $174.76 and closing at $186.50. The monthly high of $192.69 and the low of $170.31 created a $22.38 range running against a 3-month average true range of $34. The 50% midpoint sits at $181.50, and the close at $186.50 came $5 above the midpoint. December's inside month with close in the upper half suggested stabilization after November's collapse rather than continued breakdown. January 2026 resumed higher high bias, opening at $189.84 and closing at $191.13. The monthly high of $194.49 and the low of $177.61 created a $16.88 range, continuing compression, running against a 3-month average true range of $28. The 50% midpoint sits at $186.05, and the close at $191.13 came $5.08 above the midpoint. January's close above the midpoint maintained the stabilization from December, suggesting a recovery attempt was developing. February 2026 through week 6 shows lower low bias. The month opened at $187.20 and with week 6's close sits at $182.81. The monthly high reached $193.66 from Monday, week 6, and the monthly low dropped to $171.03 from Monday, week 5. This creates a $22.63 range running against a $21 three-month average true range. The 50% midpoint sits at $182.34.5, and the current close at $182.81 is 46.5 cents above the midpoint, essentially right at the midpoint. February opened at $187.20, attempting to extend January's recovery, but week 5's drop to $171.03 and week 6's close at $182.81 places the month down $4.39 from the open. Looking at the pattern of monthly closes relative to midpoints tells NVIDIA's story. August closed below midpoint, showing weakness. September closed well above midpoint, showing strength building. October closed above midpoint after making new highs, confirming peak. November collapsed to close well below midpoint, showing reversal. December closed above midpoint, showing stabilization attempt. January closed above midpoint, continuing stabilization. February now closes essentially at the midpoint after testing both above $193.66 and below $171.03, showing uncertainty about direction. Moving to the weekly time frame provides critical context for week 6's whipsaw. Week 1 of 2026 showed outside week bias, opening at $191.76 and closing at $184.86. The weekly high of $193.63 and low of $183.67 created a $9.96 range running against a 3-week average true range of $10. The 50% midpoint sits at $188.65, and the close at $184.86 came $3.79 below the midpoint, positioning week 1 in the lower half. Week 2 showed lower low bias, opening at $183.22 and closing at $186.23. The weekly high of $190.44 and low of $180.80 created a $9.64 range running against a 3-week average true range of $10. The 50% midpoint sits at $185.62 and the close at $186.23 came 61 cents above the midpoint, essentially centered. Week 3 continued lower low bias, opening at $181.90 and closing at $187.67. The weekly high of $189.60 and low of $177.61 created an $11.99 range running against a 3-week average true range of $11. The 50% midpoint sits at $183.60.5 and the close at $187.67 came $4.06.5 above the midpoint in the upper half. Week 4 shifted to higher high bias, opening at $187.16 and closing at $191.13. The weekly high of $194.49 and low of $185.70 created an $8.79 range compression running against a 3-week average true range of $11. The 50% midpoint sits at $190.09.5 and the close at $191.13 came $1.03.5 above the midpoint. Week 4's high at $194.49 marks January's monthly high, showing the recovery attempt peaked there. Week 5 delivered violent lower low bias, opening at $187.20 and closing at $185.41. The weekly high of $190.30 and low of $171.03 created a $19.27 range explosion from prior week's compression, running against a 3-week average true range of $14. The 50% midpoint sits at $180.66.5, and the close at $185.41 came $4.74.5 above the midpoint. Week 5's low at $171.03 represents the extreme test lower that, if broken, would signal breakdown from the recovery attempt entirely. Week 6, our analysis week covering February 9th through 13th, delivered higher high bias, opening at $184.26 and closing at $182.81. The weekly high of $193.66 and low of $181.59 created a $12.07 range, running against a 3-week average true range of $14. The 50% midpoint sits at $187.62.5, and the close at $182.81 came $4.81.5 below the midpoint, positioning Week 6 in the lower third. This is critical. Week 6 made a higher high at $193.66 and higher low at $181.59, maintaining a bullish structure, but closed $4.81.5 below the weekly midpoint, showing bearish character within that structure. The weekly progression, weeks 1 through 3 showed declining prices with lower low bias. Week 4 attempted recovery with higher high to $194.49. Week 5 tested that recovery violently with a drop to $171.03 before bouncing. Week 6 opened above Week 5's close, attempting continuation, made a higher high confirming the structure, but closed below the open and in the lower third, showing the recovery lacks conviction. Examining Week 6's daily candles reveal how the weekly contradiction developed. Monday, February 9th, opened at $184.26, $1.15 below Week 5's close at $185.41, a small gap down. The day spiked to $193.66, the weekly swing high, tested down to $183.95, and closed at $190.04. The $9.71 range showed higher high bias with the close in the upper portion of Monday's range. Monday's spike to $193.66 exceeded Week 4's high at $194.49 briefly, though intraday not on a closing basis, and significantly exceeded Week 5's high at $190.30, confirming higher high structure at the weekly level. Tuesday, February 10th, opened at $191.38, reached a high of $192.48, dropped to $188.12, and closed at $188.54. The $4.36 range showed inside bias, with Tuesday's entire movement fitting within Monday's range. The close at $188.54 is $1.50 below Monday's close, showing the Monday rally momentum didn't extend into Tuesday, but instead pulled back. Wednesday, February 11th, opened at $192.45, reached a high of $193.26, dropped to $188.77, and closed at $190.05. The $4.49 range showed higher high bias, with Wednesday attempting to retest Monday's high, getting within 40 cents of it. The close at $190.05 sits in the middle of Wednesday's range, showing the attempt to break higher failed but didn't collapse either. Thursday, February 12th, opened at $193.03, gap up suggesting another attempt to break the Monday high, reached a high of $193.61, 5 cents shy of the Monday peak, dropped to $186.51, and closed at $186.94. The $7.10 range showed outside bias, with Thursday exceeding Wednesday's high but also breaking below Wednesday's low before closing near the lows. This is a bearish pattern: gap up to retest the high, fail, reverse to break the prior low, close near the lows. Friday, February 13th, opened at $187.48, reached a high of $187.50, essentially flat open to high, dropped to $181.59, making the weekly low, and closed just $1.22 above that low. This is bearish capitulation. No bounce attempt succeeded, selling pressure overwhelming. The daily sequence: Monday spiked to $193.66, creating the weekly high and apparent bullish continuation. Tuesday pulled back with an inside day. Wednesday attempted to retest Monday's high, failed. Thursday gapped up for another attempt, failed again, reversed to break Wednesday's low. Friday collapsed to $181.59, making the weekly low, and closed just $1.22 above that low. The week opened at $184.26, peaked at $193.66, plus $9.40, bottomed at $181.59, minus $2.67 from open, and closed at $182.81, minus $1.45 from open. Bulls spiked it Monday, couldn't hold, and gave back the gains by Friday. Now let's interpret what the candles revealed about participant behavior, connecting the daily volatility to the weekly structure's contradiction between bullish labels and bearish positioning. The weekly candle for week 6 shows higher high, higher low structure with an upper wick to $193.66, lower wick to $181.59, body opening at $184.26 and closing at $182.81. This creates a weekly candle with approximately $10.85 of upper wick from close to high, $1.22 of lower wick from low to close, and a $1.45 red body, close lower than open. In candlestick analysis, when the upper wick dominates and the body closes lower than it opened in the lower portion of the range, it signals rejection of higher prices despite the higher high label. Week 6's pattern says bulls attempted to break higher Monday, got rejected, and bears took control by week's end, despite maintaining technically bullish weekly structure. Comparing week 6 to week 5 opened at $187.20, dropped violently to $171.03, creating a large lower wick, then recovered to close at $185.41, near the weekly midpoint. That's a hammer-type pattern at the weekly level: long lower wick showing test lower getting rejected, recovery to midpoint showing buyers defended. Week 6 opened below week 5's close, spiked higher Monday, then sold off to close below the open in the lower third. This inverts week 5's recovery pattern, suggesting the bounce from $171.03 isn't being confirmed by follow-through, but instead facing renewed selling. Moving to daily candles, Monday's pattern is a bullish spike with rejection, opening at $184.26 and spiking to $193.66, shows aggressive buying, likely driven by gap fill attempts and technical breakout traders. But the close at $190.04, $3.62 below the high, creates an upper wick showing the spike got partially rejected before the close. This isn't a bullish Marubozu with close at highs showing conviction. It's a spike with rejection, suggesting supply appeared at $193 to $194. Tuesday delivered an inside day, which following Monday's spike typically signals either consolidation before continuation or exhaustion after a failed breakout. Tuesday's close at $188.54, $1.50 below Monday, suggests the latter, exhaustion rather than healthy consolidation. Inside days after spike highs that immediately close below the spike close often precede reversals. Wednesday's higher high attempt pushing to $193.26 represents a retest of Monday's high. In technical analysis, when a prior high gets tested and fails to exceed it or close above it, that's bearish. Wednesday closed at $190.05 in the middle of its range, showing neither bulls nor bears won decisively, but the failure to exceed Monday's high by more than marginally and close there warned bulls were weakening. Thursday's outside day pattern after Wednesday's failed retest is particularly bearish. An outside day exceeds both the prior day's high and low. Thursday gapped up to $193.03, suggesting bullish intent, reached $193.61, 5 cents shy of Monday's peak, then reversed completely to break below Wednesday's low at $188.77 before closing at $186.94, near the session lows. This is classic distribution. Gap up to attract buyers, reverse to stop them out, close near lows showing sellers dominated. The pattern reveals bulls attempted 3 times, Monday, Wednesday, and Thursday, to break above $193.66 and couldn't sustain it, while bears successfully reversed each attempt. Friday's lower low candle with collapse to $181.59 and close at $182.81 is capitulation. Opening at $187.48 and immediately selling off to $181.59, $5.89 drop with minimal bounce shows panic selling or large institutional distribution occurring. The close just $1.22 above the low indicates no meaningful buying support appeared until very near the lows, and even then it was weak. The 5-day candlestick sequence tells a complete story. Monday's spike with rejection at $193.66 established resistance. Tuesday's inside day showed momentum fading. Wednesday's failed retest confirmed resistance holding. Thursday's outside day with reversal from the highs showed bears taking control. Friday's collapse confirmed the reversal is real, not just a pullback. This is a textbook distribution pattern at a failed breakout level. Connecting to the weekly and monthly structure, Week 6's candle with a large upper wick, lower close than open, and positioning in the lower third mirrors similar warning signs from prior reversals. October's peak at $212.19 was followed by November's collapse. October's candle likely showed similar rejection wicks. Week 6's pattern within the recovery attempt from $171.03 suggests the recovery is being rejected just as October's rally was, potentially signaling another leg lower ahead rather than sustained recovery. The contradiction between weekly structure, higher high, higher low, and weekly behavior, close lower than open in the lower third with rejection pattern, is the critical message. Technical structure labels can lag price behavior by a period. Week 6 might technically show higher high, higher low, but the behavior says the higher high was rejected, and the close in the lower third signals bears winning despite the labels. Our decision zones framework uses swing structure and Fibonacci price analysis to determine NVIDIA's next move based on Week 6's contradiction between bullish structure labels and bearish close positioning. Current price sits at $182.81 as of Friday's Week 6 close. We're positioned $1.22 above the weekly low at $181.59, very close to support, and $10.85 below the weekly high at $193.66, far from resistance. This asymmetric positioning, much closer to support than resistance, combined with closing below the weekly open, creates bearish spew despite the higher high, higher low labels. Above current price, Monday's weekly swing high at $193.66 sits $10.85 higher. Week 4's high and January's monthly high at $194.49 sits $11.68 higher. October's peak at $212.19 sits $29.38 higher. This represents the ultimate resistance, and if exceeded, would signal resumption of the multi-year AI-driven rally rather than correction. Below current price, Friday's weekly swing low at $181.59 sits just $1.22 below, immediate critical support. Below that, week 5's extreme low at $171.03 sits $11.78 below current price. This $171.03 level is critical. It represents the bottom of February's range, the lowest test since November's collapse, and if broken, would signal the recovery attempt has failed completely. For Fibonacci price analysis, calculating our Fibonacci resistance zone from October's peak at $212.19 down to week 5's low at $171.03 gives us a $41.16 range. The 61.8 to 78.6% zone sits at $196.46 to $202.57. This Fibonacci resistance zone is well above current price, $13.65 to $19.76 above, showing how far we'd need to rally to enter resistance territory where sellers from October's peak would likely appear. For the Fibonacci support zone, calculating from October's peak at $212.19 down to Friday's weekly low at $181.59 gives us a $30.60 range. The 61.8 to 78.6% zone sits at $193.27 to $197.34. Current price at $182.81 sits $10.46 to $14.55 below this zone, showing we're well beneath even the support zone calculated from the recent swing. More relevant for near-term analysis, calculating Fibonacci support zone from week 6's high at $193.66 down to week 5's low at $171.03, the February range, gives us $22.63. The 61.8 to 78.6% zone sits at $185.02 to $188.83. Current price at $182.81 sits $2.21 to $6.02 below this support zone, showing we broke below it Friday. This positioning is significant. We closed below the Fibonacci support zone calculated from February's range. We're just $1.22 above the weekly swing low, and we're $11.78 above the critical $171 support that, if broken, confirms failure. Based on week 6's structure and close positioning, here's our probability assessment. Scenario 1, bearish breakdown, carries 45% probability. Week 6 technically made higher high, higher low labels, maintaining bullish structure labels, but the close $145 below the open, positioned in the lower third $4.81.5 below the weekly midpoint, breaking below the Fibonacci support zone, and sitting just $1.22 above the weekly swing low, all create substantial bearish risk. Friday's collapse to $181.59, with close barely above it, suggests support is fragile. The pattern of Monday's spike rejected, Thursday's failed breakout, Friday's collapse mirrors distribution patterns seen at prior reversals. Bearish carries the highest probability because the behavior contradicts the bullish structure labels. Scenario 2, range-bound consolidation, carries 35% probability. Week 6's higher high, higher low structure technically maintains the recovery sequence from week 5's $171 low. The range compression to $12.07 versus week 5's $19.27 suggests volatility declining. If Friday's $181.59 and the major $171 support hold, while $193 to $194 resistance rejects rallies, a range bound between $170 to $195 becomes plausible. Range bound is secondary to bearish because the lower third close and rejection patterns suggest a directional bias lower rather than neutral consolidation, but it remains meaningful probability given support hasn't broken yet. Scenario 3, bullish continuation, carries 20% probability. For bulls, week 6 made a higher high, confirming the recovery attempt from $171.03 is developing bullish structure. The low at $181.59 held above $171, preventing breakdown. If week 7 can reclaim $190 and break above $193.66 with follow-through, the bullish sequence would strengthen. However, probability is lowest because Monday's spike rejection, Thursday's failed breakout, Friday's collapse, and close in the lower third all contradict bullish conviction. The structure maintains bullish possibility, but behavior makes it least likely unless dramatic reversal occurs week 7. Defining precisely what validates or invalidates each scenario, our probability weighting. Scenario 1, bearish, 45%. Scenario 2, range-bound, 35%. Scenario 3, bullish, 20%. This reflects week 6's lower third close and rejection pattern, creating bearish bias despite technically bullish structure labels. Scenario 1, bearish validation, requires breaking Friday's weekly swing low at $181.59 with a daily close below it, showing Friday's low wasn't the bottom. Following that break, acceleration toward and through the Fibonacci support zone at $185 to $189 already broken, and ultimately toward week 5's critical low at $171.03. Bearish candlestick patterns supporting decline, more outside days with reversals from highs, shooting stars on bounce attempts, bearish engulfing patterns would validate selling pressure. The ultimate validation is breaking $171.03 with daily close below it and follow-through, confirming the recovery from November's collapse has failed and resumption of decline is underway. This would shift probability to 70% or higher bearish, opening targets toward November's low at $169.55 and potentially December lows around $170.31. At the weekly level, bearish validation requires week 7 to make a weekly low below $181.59 and close below week 6's close at $182.81, creating a lower high, lower low structure that invalidates the bullish sequence. What invalidates scenario 1? If $181.59 holds as support, producing bullish reversal patterns, hammers with long lower wicks, bullish engulfing candles, dragonfly dojis, that invalidates bearishness. If week 7 makes a weekly low above $181.59, maintaining higher low structure, bearish at the weekly level is invalidated. Most obviously, if NVIDIA rallies and breaks above $193.66 with daily closes sustained there, bearish is invalidated and Scenario 3 activates. Scenario 2, range-bound validation, requires both $181.59 and the major $171 support to hold when tested, while $193 to $194 resistance rejects rallies. We'd watch for bullish patterns when testing $180 to $182, hammers, bullish engulfing, showing buyers defending. On rallies toward $190 to $193, bearish patterns, shooting stars, bearish engulfing, gravestone dojis, showing sellers appearing. The key validation is compression. If week 7's range compresses to $8 to $10 from week 6's $12, that confirms consolidation tightening. Multiple inside days developing, 3 or 4 in week 7 versus typical 1 or 2, validates compression. If the 14-period average true range, currently around $7, starts declining towards $6 then $5, that's volatility contracting. What invalidates scenario 2? Daily close below $171.03 invalidates range-bound and confirms scenario 1. Daily close above $194.49 sustained invalidates range-bound upside and activates scenario 3. If ranges expand rather than compress, week 7 producing $18 to $20 range, that's directional movement, not consolidation. Scenario 3, bullish validation, requires reclaiming $190 as support with daily closes sustained above it, then breaking Monday's high at $193.66 with strong bullish candle, large green body, close near highs, minimal upper wick. Following the breakout, we need higher highs and higher lows developing daily, with each day respecting the prior day's low. Most critically, Week 7 must make a weekly low above $181.59, ideally above $185, and make a weekly high above $193.66, confirming higher high, higher low weekly structure continuing, with conviction this time, rather than rejection. Beyond just breaking the weekly high, full bullish validation requires challenging Week 4's high at $194.49 with close above it, showing we're not just retesting but exceeding prior resistance. The ultimate validation would be approaching $200, showing the recovery toward October's $212 peak is resuming. What invalidates Scenario 3? Failure to reclaim and hold $190 invalidates early. Breaking below $181.59 invalidates completely. Week 7 making a weekly low below $181.59 invalidates the needed higher low structure. Breaking $171.03 invalidates all bullish scenarios. Current state, Scenario 1 bearish at 45%, reflects the lower third close, rejection pattern Monday, Thursday, and Friday, proximity to support at $181.59, and break below Fibonacci support zone, all creating meaningful breakdown risk. Scenario 2 range at 35% reflects the technically intact higher high, higher low structure and support not broken yet, making consolidation plausible but secondary to bearish given the lower close and weak Friday. Scenario 3 bullish at 20% reflects structure maintaining possibility but behavior contradicting conviction, requiring proof with sustained break above $193.66. Looking ahead for timing of potential directional resolution. March 20, 2026, 33 days from today, major, spring equinox. May 5, 2026, 79 days, minor, Beltane. June 21, 2026, 126 days, major, summer solstice. August 7, 2026, 173 days, minor, Lammas. September 22, 2026, 219 days, major, autumn equinox. November 7, 2026, 265 days, minor, Samhain. December 21, 2026, 309 days, major, winter solstice. February 4, 2027, 354 days, minor, Imbolc. The spring equinox on March 20th, 33 days ahead, provides timing context for potential resolution of the current structure. NVIDIA's rally from $49 in early 2023 to $212 in October 2025 was driven by explosive AI demand for its graphics processing units, with data center revenue growing exponentially as every major tech company raced to build AI infrastructure. The semiconductor shortage worked in NVIDIA's favor as the only company with chips capable of handling the computational demands of large language models and AI training. The AI revolution narrative justified premium valuations. The subsequent volatility, November's collapse to $177, the recovery attempt to $194 in January, Week 5's test to $171, and Week 6's rejection at $193 reflects shifting narratives. Competition is emerging, with AMD and Intel launching rival AI chips, though NVIDIA maintains technological lead. Concerns about AI investment sustainability emerged as companies questioned ROI on massive AI spending. Valuation debates intensified, with NVIDIA trading at premium multiples requiring continued explosive growth. Macroeconomic concerns about potential recession or tech sector weakness created headwinds. Scenario 1, bearish, would be supported by earnings disappointment, competitive threats materializing, AI investment slowdown, or broader market weakness affecting tech. Scenario 2, range, would align with mixed signals, solid earnings but tempered guidance, competition acknowledged but lead maintained. Scenario 3, bullish, requires earnings beat, accelerating AI adoption, new product announcements, or major contract wins validating the premium valuation. Our directional lean is bearish with 45% probability assigned to Scenario 1. This isn't prediction, it's assessment based on Week 6's lower third close, rejection of Monday's spike, Thursday's failed breakout, Friday's collapse to $181.59, and close in the lower third at $182.81, $1.45 below the open, positioning just $1.22 above support. The contradiction between higher high, higher low structure labels and actual close below the open in the lower third suggests labels are lagging behavior. The framework. Above us, $193.66 resistance sits $10.85 higher. Below us, $181.59 support sits $1.22 lower. Major support at $171.03 sits $11.78 below. For Week 7, if we open and test lower, watch whether $181.59 breaks with daily close below it. If that breaks with bearish patterns, shooting stars on bounces, bearish engulfing, probability shifts higher bearish toward $171.03. If instead $181.59 holds, producing hammers or bullish engulfing, that validates Scenario 2 consolidation. For bullish Scenario 3, we'd need early week strength reclaiming $190 sustained and breaking $193.66 with follow. The overarching principle. Week 6 delivered technically bullish higher high, higher low structure, but behaviorally bearish close in lower third with rejection pattern. Week 7 determines whether $181.59 breaks, confirming Scenario 1 bearish at 45%, holds creating Scenario 2 range at 35%, or we reverse dramatically for Scenario 3 bullish at 20%. Let price action at these levels, candlestick patterns, and structure development tell you rather than hoping or predicting. If this analysis helped you understand how technically bullish structure can carry bearish implications through close positioning and rejection patterns, hit that like button and subscribe for daily breakdowns. We publish institutional-grade price action analysis on all major stocks every day using this exact framework. We also run separate dedicated channels for crypto, forex, futures, and metals, each with daily analysis. All links are in the description. And remember, trade what you see, not what you think. Week 6 showed us higher high and higher low structure. That's what we saw in the labels. But Monday's spike to $193.66 getting rejected, Thursday's failed breakout, Friday's collapse to $181.59 and close in the lower third at $182.81, $1.45 below the open, revealed distribution and rejection. That's also what we saw. We assigned 45% probability to bearish based on the behavior contradicting the bullish structure labels, not because we think it should go down. The market shows us truth through candles, closes, and positioning. If this analysis helped you understand how whipsaw volatility within bullish structure signals consolidation rather than clear trend, hit that like button and subscribe for daily breakdowns. We publish institutional-grade price action analysis on all major metal contracts every day using this exact framework. We also run separate dedicated channels for crypto, forex, futures, and metals, each with daily analysis. All links are in the description. And remember, trade what you see, not what you think. Week 6 showed us higher high and higher low structure. That's what we saw in the labels. But Monday's spike to $193.66 getting rejected, Thursday's failed breakout, Friday's collapsed to $181.59 and close in the lower third at $182.81, $1.45 below the open, revealed distribution and rejection. That's also what we saw. We assigned 45% probability to bearish based on the behavior contradicting the bullish structure labels, not because we think it should go down. The market shows us truth through candles, closes, and positioning. If this analysis helped you understand how whipsaw volatility within a bullish structure signals consolidation rather than clear trend, hit that like button and subscribe for daily breakdowns. We publish institutional-grade price action analysis on all major metals contracts every day using this exact framework. We also run separate dedicated channels for crypto, forex, futures, metals, and stocks, each with daily analysis. All links are in the description. See you in tomorrow's analysis.